If you think Las Vegas is simply too expensive now, you are missing the real story. The price hikes are not just about inflation, they are about elimination. But what if this ruthless crusade against the average customer is a catastrophic miscalculation? In this video, we will reveal the shocking internal statements, where casino leadership admits to targeting their own patrons, creating the empty casinos you see today. So how does a plan to make more money result in a ghost town? What is happening in Las Vegas is not an accident. It is not simply inflation or market forces at work. It is a calculated, deliberate strategy that casino executives themselves have proudly announced on earnings calls and investor meetings. The shift began during the post-pandemic recovery of 2021. While most businesses were desperate to welcome customers back, Las Vegas casino executives discovered something that changed their entire business model. They could make more money from fewer people. Let me say that again. They realized they could generate higher profits by serving fewer customers at higher prices rather than by maintaining volume at reasonable rates. And this revelation sparked what insiders now call the velvet rope economy approach to Las Vegas. The math was simple and ruthless. If a casino can make $500 from one high roller instead of $100 each from 5 budget-conscious visitors, why bother with those 5 people? They take up more space, require more staff, and consume more complimentary services. In the cold language of corporate efficiency, the average Vegas visitor had become unprofitable. This is not speculation. This is straight from the mouths of the executives who run these casinos. They have made a conscious decision to transform Las Vegas from the people's playground into an exclusive resort destination for the affluent. The average American who saved up for that once-a-year trip to Vegas has been deliberately priced out of the market. And it's not just about room rates. It's resort fees that have ballooned to $50 per night. It's $30 parking fees. It's $25 cocktails and $90 buffets. It's the systematic elimination of budget options, free amenities, and comps that once made Vegas accessible to middle-class America. This customer elimination strategy represents a fundamental shift in how these corporations view their relationship with you, the customer. You are no longer valued for your loyalty or frequency of visits. You are assessed purely on your dollar value, and if that value is not high enough, you are expendable. Don't take my word for it. Let's look at what casino executives themselves have said in public forums, investor calls, and industry conferences. In February 2023, Caesars Entertainment's CEO Tom Reeg made headlines when he openly admitted during an earnings call that they were deliberately eliminating certain customers. He said that what they had really done was kick out the lowest end of their database. He was not talking about problem gamblers or troublemakers. He was talking about loyal customers who simply did not spend enough money per visit. This was not an offhand comment. It was a proud announcement of their strategy, delivered to investors as proof that they were maximizing profits. He went on to explain that Caesars had reduced their promotional allowances, meaning the comps and discounts that loyal players receive, by over 20%. This was presented as a victory, not a failure, of customer service. By late 2023, MGM Resorts CEO Bill Hornbuckle joined in with similar statements. During MGM's third quarter earnings call, he told investors they were focusing on the premium customer and reducing dependency on the value-oriented segment. In plain terms, they were pushing out budget travelers to make room for wealthy ones. In early 2024, the strategy escalated further. Hornbuckle said MGM was comfortable with the decline in occupancy rates because the remaining customers were spending more per visit. Think about that. A hotel company celebrating empty rooms because the few rooms that are occupied are generating more revenue. The data backs up these statements. According to the Las Vegas Convention and Visitors Authority, total visitor volume in 2023 was still below pre-pandemic levels, but gaming revenue hit record highs. How? By extracting more money from fewer people. By mid-2024, we saw the next phase of this strategy. Properties that once catered to budget-conscious visitors began disappearing. The Tropicana closed its doors after 67 years. The Flamingo, once a cornerstone of the Strip, announced a complete rebrand into a luxury property, with room rates starting at $300 per night. This was not market forces at work. It was a coordinated effort by the major casino corporations to fundamentally transform Vegas into a playground exclusively for the affluent. The most damning evidence came in August 2024, when an internal memo from a major casino group leaked to the press. The memo explicitly stated their goal to transition away from low-value customers and outlined strategies to identify and discourage budget travelers from booking. Methods included eliminating lower-priced room options, removing affordable dining choices, and implementing minimum spending requirements for rewards program benefits. By early 2025, executives from Wynn, MGM, Caesars, and Las Vegas Sands were all singing from the same hymnal, celebrating higher per-customer spending while dismissing concerns about declining visitor numbers. The message was clear. If you are not a high spender, Las Vegas does not want you anymore. So what is driving this radical shift in strategy? Why would businesses deliberately turn away paying customers? The answer lies in Wall Street expectations and the changing ownership structure of Las Vegas. The days of mob-connected operators who understood the casino business are long gone. Today, most major Las Vegas properties are owned by publicly traded corporations, answerable to shareholders and investment firms. Publicly traded ownership changes the incentives. Wall Street does not care about visitor volume or customer satisfaction. Wall Street cares about quarterly profits and EBITDA, earnings before interest, taxes, depreciation, and amortization. Investment analysts have been pushing casino operators to focus on margin optimization rather than visitor numbers. In simple terms, they want casinos to squeeze more profit from each customer rather than serve more customers. Margin optimization became the priority. Casino executives, whose compensation packages are often tied to stock performance, have been all too eager to comply. This pressure intensified during the pandemic recovery. As Las Vegas reopened with limited capacity, executives discovered they could maintain profits with fewer customers by simply charging more. What began as a temporary adjustment became a permanent business model. There is also what some call the Monaco model, the idea that Las Vegas should emulate exclusive European destinations like Monaco or Asian hubs like Macau, catering primarily to ultra-wealthy gamblers and tourists. That vision has seduced many casino executives, even though Las Vegas was built on accessible luxury for the masses. Perhaps the most insidious aspect of this transformation has been the rise of what industry insiders call FEE optimization. This is the practice of breaking down every aspect of a Vegas visit into a separate billable transaction. Room rates might seem reasonable, but then come the resort fees, parking fees, venue fees, service charges, and convenience fees. A classic example is the resort fee, which has ballooned from a nominal charge to as much as $50 to $70 per night at some properties. This fee rarely provides any additional value. It is simply a way to extract more revenue without raising the advertised room rate that appears on booking sites. The same goes for parking fees, introduced in 2016 and now as high as $30 per day at some strip properties. For decades, free parking was a Vegas staple. Now it is seen as another revenue stream to optimize. Even the loyalty programs, once designed to build customer loyalty, have been systematically devalued. Point requirements for comps have increased, while the value of those comps has decreased. As one casino executive said at an industry conference in 2024, loyalty programs should be profit centers, not cost centers. The human impact of these corporate decisions is devastating, and you do not have to look far to find it. Social media platforms and travel forums are overflowing with testimonials from longtime Vegas visitors who feel priced out and pushed aside. On Reddit r/Vegas, one 15-year regular visitor posted that his wife and he have been coming to Vegas twice a year since 2008. This year, they priced out their usual 5-day trip, and it was literally triple what they paid in 2019. They are not poor, but they cannot justify spending what used to be their entire vacation budget just on hotel and food. Another visitor wrote that what breaks their heart is that Vegas used to be the place where a factory worker could feel like a king for a weekend. Now it is just another playground for the rich. The impact is not just on tourists. Las Vegas locals are watching their city transform before their eyes. A dealer who has worked on the Strip for over 20 years said the floors are empty compared to what they used to be. Some weekends are still busy, but Tuesday through Thursday are ghost towns. And the worst part is management seems happy about it. A cocktail server at a major strip property said they used to serve customers who came here 4 or 5 times a year. Those guests were not big spenders, but they were loyal. Now staff are told to focus on the high rollers who might come once and never return. It feels like we have betrayed the people who built this place. Local business owners off the strip are feeling the impact. A restaurant owner in downtown Las Vegas said, "Tourists now spend all their money at the expensive strip venues. They do not venture downtown or to local spots like they used to. Business owners are seeing less foot traffic, and visitors who do come have already blown their budgets on dinners that cost $300 and cocktails that cost $30 on the strip." Perhaps most telling are the comments from taxi and rideshare drivers who have a unique perspective on visitor patterns. One driver with 12 years of experience noted that he used to make 25 to 30 trips a day around the strip. Now he is lucky to get 15. There are just fewer people, and the ones who are here stay put in their expensive resorts instead of exploring the city. Even influencers and travel bloggers who once championed Las Vegas as the ultimate value destination have changed their tune. Popular travel vlogger Vegas Vacation Hunter, who built a following of over 500,000 subscribers by showcasing budget-friendly Vegas trips, recently posted a video titled, "Is Vegas Worth It Anymore?" that garnered over 2 million views and thousands of comments from disillusioned former visitors. The most alarming aspect of this strategy is that it appears to be backfiring in spectacular fashion. The customer elimination plan was supposed to create a more profitable Las Vegas, but instead, it is creating a cycle of decline that threatens the entire ecosystem. The first signs of trouble appeared in late 2024, when occupancy rates at major strip properties fell below 80% during what should have been peak periods. Casino executives initially dismissed these numbers, claiming that higher room rates compensated for fewer filled rooms. But by early 2025, even gaming revenue began to plateau and then decline. The fundamental miscalculation is this: Las Vegas was built on volume, not exclusivity. The entire infrastructure of the city, from massive hotels to expansive casino floors to 20,000-seat arenas, was designed to accommodate millions of visitors. When operators deliberately reduce that volume, the fixed costs remain the same, and the revenue base shrinks. Fixed costs do not fall just because there are fewer guests. This creates a domino effect throughout the entire Las Vegas ecosystem. With fewer total visitors, entertainment venues struggle to fill seats. Shows that once ran twice a night now run once, or only on weekends. Some have closed altogether. Restaurants built to serve hundreds of diners per night sit half empty, leading to reduced hours, simplified menus, and eventually closures. Retail outlets and casino shopping arcades that rely on foot traffic have seen sales decline precipitously. Many have closed or been replaced by high-end luxury boutiques that may see only a handful of customers per day, but generate higher per-transaction revenue. The problem is, these shops do not create the bustling, exciting atmosphere Vegas was famous for. Even the high-end properties that initially benefited from this strategy are now feeling the pinch. It turns out that the pool of ultra-wealthy gamblers and travelers willing to spend $1,000 per night on rooms and $500 on dinner is much smaller than executives anticipated. And unlike the loyal mid-market customers they pushed away, these high rollers are fickle, constantly chasing the newest, most exclusive experiences around the globe. The most concerning development came in April 2025, when financial analysts at Goldman Sachs downgraded multiple casino stocks, citing concerning trends in customer acquisition costs. In plain terms, the casinos are now spending more and more on marketing to attract wealthy customers, eroding the very profit margins they were trying to enhance. Perhaps the most telling statistic comes from a recent survey of first-time Vegas visitors. 78% said they were unlikely or very unlikely to return, citing high costs as the primary reason. This breaks the fundamental cycle that kept Vegas thriving for decades, converting first-time visitors into repeat customers. The hard truth that casino executives don't want to face is that sustainable business isn't built on eliminating your customer base. It's built on expanding it, nurturing it, and creating loyal, repeat customers who feel valued. There are glimmers of hope in this otherwise bleak landscape. Some properties, particularly those off the strip, have recognized the opportunity created by this misguided strategy. Downtown Las Vegas casinos like El Cortez and the D have maintained more reasonable pricing and continue to offer value-oriented experiences. And guess what? They are thriving, with occupancy rates consistently above 90%. The station's casinos properties, which cater primarily to locals, have reported record earnings by maintaining their focus on value and customer loyalty. The rewards programs still offer meaningful benefits. The restaurants provide quality meals at reasonable prices, and their entertainment options remain accessible to average consumers. Even on the Strip, a few outliers are bucking the trend. The Horseshoe, formerly Bally's, has repositioned itself as a mid-market alternative to the luxury-focused neighbors. Visitor numbers suggest the strategy is working. The solution is simple, though painful for the corporate egos involved. Las Vegas needs to return to its roots as an accessible luxury destination. The city was built on the promise that ordinary people could, for a few days, experience extraordinary things at prices they could afford. This does not mean abandoning the high-end market. Las Vegas has always had luxury options for those willing to pay for them, but the city thrived by offering multiple tiers of experiences across the price spectrum. The casinos that survive and thrive in the coming years will be those that recognize this fundamental truth and adjust their strategies accordingly. They will reintroduce value options, reasonable fees, and rewards programs that actually reward loyalty. They will remember that a customer who visits 4 times a year, spending $500 each time, is more valuable than one who visits once and spends $1,500. The alternative is a continuing spiral of decline, with increasingly desperate casinos chasing an ever-shrinking pool of ultra-wealthy customers, while the massive infrastructure built for volume sits underutilized. They betrayed the loyalty you showed for decades. We are here to expose every corporate lie. What is your Vegas story? Comment below, hit subscribe if you want more truth, and let us make them accountable together.